Get started. I'll kind of kick this off. Happy New Year, everyone. Appreciate everyone joining us today, and super excited about our first Tech Talk of 2024. Last year was a great year. I don't remember how many Tech Talks we actually did, but it was quite a few of them. Had a lot of great conversations with industry leaders. Had a couple of those that were kind of internal chats, but it was really useful for me. I think useful for the group. And I'm excited to see the number of participants kind of continue to grow with these every other week meetings. Before I turn it over, just wanted to again thank the team from SRM. We've got a number of folks on the call. Paul Davis, who's the Director of Market Intelligence, and he will be moderating today's discussion. Caleb Howe, Dillon Gannon, William Pickering, and then Russ Bourne, kind of the leader of the group, and that team is our analysts and research team. So with that, I'm going to turn it over to Paul. You guys all know I like to talk, and I'm going to try not to do that in this case, but I will be monitoring the chat. Feel free for anyone to ask questions. Just would appreciate if everyone kind of puts their microphones on mute to start. And then if you want to jump in, either raise your hand or take yourself off mute. We'll do the same thing we usually do, which is about 40 minutes of conversation, presentation, and then we'll have 10 to 15 minutes that we'll save for questions at the end. So with that, I'll turn it over to Paul Davis, and we can get this kicked off.
Thanks, Larry. And I will say it's a huge vote of confidence that Larry is willing to just hand the keys over to me for the next 45 minutes to an hour. So we'll have a good time with it, Larry. As Larry mentioned too, I tend to keep things kind of conversational here. So you'll see, maybe just a general idea. I've talked to these guys, a general idea of where we're going to go, but I could see this conversation going in a lot of different ways. So I've got the chat section open too. So if you have a question that you want to slide into the conversation, by all means, slide it, post it, and I'll see if I can work it in. Otherwise, we will have some time for Q&A at the end of this discussion. Anyway, so that being said, the thing I love about the setup here is that we're going to be able to showcase a lot of different folks at SRM, particularly focusing on our research and analytics capabilities. Got a great panel here. I'd love to just start, if each of you guys could just take a quick second, introduce yourself, share a little bit about your background, and also just kind of what your real passion is when it comes to data analytics. I mean, if there's a particular area that really is of interest to you. So Caleb, why don't we just start with you, if you don't mind.
Yeah, absolutely. Hey guys, good afternoon. My name is Caleb Howe. I've been in the financial technology industry a little over 6 years. Started with SRM right at a year ago. Before that, I was at FedEx and their financial technology organization and led several fintech projects for them, and it was an incredible experience, and that's continued with SRM. And then as far as passion for data analytics, I think really for me and this project that we did and kind of some of the things we're going to share with you today really showcases it. It is learning, getting in and looking at the numbers and looking at what people are saying and kind of the trends and really learning from that. And there's certainly a lot to learn in this industry, and that's something that we do each and every day. And so I think that really brings that passion to fruition. So that's me.
Hey guys, I'm William Pickering. Oh, can y'all hear me?
Yep, absolutely. Loud and clear.
Okay, cool. Yes, I'm William Pickering. So my background, I spent 8 years with 2 regional banks here in town in Memphis, First Horizon and Simmons Bank. I was kind of focused at that time on credit underwriting and doing a little bit of relationship management as well. And so 6 months ago, I joined SRM. It's been an awesome place to work, and really all that I've been doing the past 6 months is learning about the payments and tech industry. And so it's been a lot of fun learning. And then through this project that we did, we learned a lot and read a lot of different resources, and it was really helpful. And it's just been a fun process.
Great. Dillon, you want to go next?
I'm Dillon Gannon. I've been in financial services for about 7 years as well. I started as an intern in our asset-based lending group at First Horizon. So I cut my teeth there, and then they sent me to the Barrett Graduate School of Banking. So I got exposed to a lot more of the community side of things. Started getting interested in that, and switched over to FHN Financial, where there I was running ALM models and doing a lot of interest rate risk modeling, and segued that into bond portfolio management with the same emphasis on interest rate risk management and liquidity management, more of a holistic picture rather than just chasing yield. But yeah, I've been with SRM for 6 months, same cohort of hiring as William. And yeah, it's just things move really fast over here. It's very exciting. And then as far as data analytics, what I like about it is similar to what Caleb said, just insights that you find that you didn't think were there. Something that you get into it and then all of a sudden your eyebrow raises and you say, really? You chase that down a little bit and yeah, you go down a whole rabbit hole.
Okay. Who wants to go next?
Yeah, I think we
go
got
ahead, Connor. You go ahead, Connor.
Connor on too.
Yeah, Connor.
Sure. Yeah, happy to. Connor Heaton, I'm SRM's VP of AI and Intelligent Automation. I've been in consulting almost a decade, working with various forms of AI for most of that time, starting off with Deloitte's federal automation practice, working with clients like the Treasury Department, Department of Defense, and continuing through my time at SRM. Overall, I focus on helping clients get their arms around innovation and technology strategy.
Great. Are we missing anybody?
That's it.
Great. Well, hey, let's just talk big picture first, because I know we want to save a lot of time to talk about technology, but let's just talk big picture, kind of give us a sense of kind of where we are in the industry, right? And then, looking at some of the research, some of the surveys, what do you guys think are really the expectations for bankers and credit union executives as we kind of enter through some interesting and somewhat uncertain times going into 2024?
Yeah, I'll start. 2023 was a really interesting year. I was at Simmons Bank 6 months ago, and while I was there, the liquidity crunch just really hit, and Silicon Valley Bank and Signature Bank and all those crashes, and immediately there was just a ton of attention to deposits. And I think that was already a growth or already a major concern with the rising interest rates, but it was just a total focus, and the competition was fierce, and it was really tough to compete there. And it was especially tough to manage your interest rate margin or your net interest margin due to the quick rate hikes over the year. And so things kind of stabilized at the end of the year. And I think looking forward, I think we've got a chance for a decent year. Treasury rates have slowly dipped the last couple of months of the year. Inflation's quelched a bit. And so I think we've got a really good opportunity maybe for liquidity compression to improve and for loan growth even to maybe come about late 2024. I mean, I think we're expecting rates to fall maybe 100 bips over the next year. And it's not like I'm a total expert in everything, but that's everything that I'm seeing lately.
Yeah, I would agree. We're at kind of an interesting crossroads where, 2023 was a bit of a scramble of a year, trying to figure out, okay, how do we just keep our feet underneath us and not wind up on one of those RIP lists for banks? And then now, how are we going to figure out how to operate in this new interest rate environment? We had 10 years of easy money, and then we've got to really start crafting new strategies around, all right, this is going to stick around for a while. How are we going to manage, cater to our customers as new technologies come along, and we're trying to customers are getting poached by fintechs, people that aren't beholden to the same regulators that the community bank space is. And then, also fighting headwinds of margin compression.
Yeah, and Paul, it's funny, as these guys have been talking, I think, a big theme that emerged last year, and I think will probably continue into a lot of 2024, is growing those deposits, right? with the liquidity crunch, increasing those deposits and making sure that that liquidity can increase. And that's something that we really are seeing a theme on in the technology side. I mean, we're seeing from these surveys that we've looked at, from the secondary research we've conducted, these banks are telling us loud and clear this is something that they're investing in. And I'm sure a lot of people on this call today feel the same way. Retail account opening, business account opening, the tools that support that, making it as easy as possible for accounts to be open and for deposits to increase. And so I can't agree more with what these guys have said, and the technology piece of that just really emphasizes that as well.
Yeah, I mean, it looks to me, I think we've talked about this. One of the reports that I know we've all been looking at was the Conference of State Bank Supervisors, right? They do an annual survey of community bankers. And, I look at last year in terms of deposits as two phases. One was the panic that I guess that we had in March and April, where I think I wouldn't call it a crisis. I call it a panic, just because people were really just in a hunker down defense mode, hold on to deposits, especially. And then there was a lot of scrutiny over uninsured deposits, deposit concentrations. And it seems like we've kind of settled into now a phase where it's really more about, the sense of urgency maybe has passed, but the sense of necessity is still upon us, where you need good low cost funds, and you need them particularly if the rate environment changes and suddenly you have more demand on the lending side. But the thing about that CSBS study that's interesting, and if you guys want to talk about it, was when you looked at the biggest external risks for community bankers, it was all about what we just talked about. It was net interest margin, cost of funds, core deposit growth. Those all were high, of a greater concern than even regulation or the economy. Kind of curious if anybody had any other observations from that study. Or do you guys just think that that's going to be the situation? That's going to be the situation, right? Going at least to the first couple quarters here, is continuing to that kind of continuation of the end of last year, with deposits really being a focus.
Right. I think the cost of funds is obviously a huge concern, but those are factors that you really can't control, or really can't control totally. So really, core deposit growth is the only way that you can really mitigate that risk.
Mm-hmm.
Yeah, and I think there's a bit of a kind of triage going on as well. So we're all finance people. We think in P&L. So we're concerned about, all right, this is hitting my bottom line now. And then, working back from there.
Whereas it also seems like some of the sharper bankers out there are the ones that are now in a position of trying to figure out how to prepare for 6-12 months down the line, right? In terms of having the right infrastructure in place, so that when things change, you're better positioned. It's not just about today, it's about the future, right? So anybody want to kind of talk about that a little bit in terms of what you guys have seen?
Yeah.
Bob?
Go ahead.
I was going to say, I'll jump in with one observation, one thing just to consider that might change in 2024 versus 2023 is, I believe it was the CFTC has come out and is looking to regulate the large financial or fintechs, so the technology companies, under a similar sort of regulatory structure as, say, banks or credit unions might have to abide by. And I think there's going to be a leveling of the playing field, where last year we saw, I think, whether it was Apple with their high yield interest savings account or others, kind of take business away from the banks and credit unions, cryptocurrency companies included in that. A lot of those deposit outflows were to higher yield solutions, but a lot of those higher yield solutions were the fintech. Well, now that fintechs are going to be playing at a much more level playing field, that might provide some relief for the banks and credit unions in seeing some of those deposit outflows. That's at least one observation or one consideration for the upcoming year.
Yeah, makes sense. And just kind of jumping off of Larry's point, let's talk a little bit about technology. You guys have done a lot of research into technology trends. What are the kind of the big things that we should be looking at in 2024?
I think there's several themes that we've seen emerge, and I think they play directly into what we've talked about so far. So digital account opening is huge, and this is something that we saw last year and something that will continue, where I think it was 48%, and we talk about that survey, and 48% of the institutions surveyed said that retail account opening was something that was really invested in last year. Well, that's flipping the year ahead. So they asked the same question, what are you investing in for the next year? And it was interesting, it flipped from retail to business. And so you come with the understanding of, okay, we've shored up the retail side of this, we've made improvements there. Now let's switch to business. And that's exactly what we saw in that survey. It was 28% for 2023. They're saying it's going to be 53% for 2024. And that's obviously a very large jump. And another thing coming out of that survey, when you kind of get into the granular piece of it, and you say, okay, so you say you want to funnel some money in and really invest in these capabilities. Beyond that, what is the technology enabling that? And a lot of these institutions surveyed said, look, we're going to spend money on remote deposit capture, on LOS systems, on e-signature. And so that what that's saying is, look, we want to make it as easy as possible for our members, for our customers, to open accounts, to deposit money, to get loans. They want to make it as effortless as possible. And I can speak, from personal experience over the past couple of years. I mean, it used to take an act of Congress to do anything online with a bank, short of looking at your balance, updating, if some account related settings. You'd have to go into the bank or the credit union to do most of that. There's a lot of stuff you can do online now, and I think that's going to continue. And so that's a huge theme. Second, and probably most important, and I'd like to spend a little bit of time on this, are payment capabilities. There are more payment options out there than ever now, right? So if we're talking about that same question that was asked, where we were talking about retail and business, and we saw a lot of different things flip, a lot of different priorities shift. Payments capabilities stayed the same from 2023 to looking ahead to 2024. 47% of those institutions say, look, we want to invest in payment capabilities. We did it last year. We're going to continue to do it in the future. And I think with the surgence of RTP solutions like FedNow, with digital wallet and instant issuance becoming huge, that's something that's going to continue to grow. I mean, you look at FedNow, right? So currently, the question that was asked is, what are the current payment capabilities that you offer to your members or customers? 61% said Zelle, and I don't think that would shock anybody. 11% said FedNow. Again, no surprise. What the surprising number was is looking ahead 18 months, the same institution said 67% of them want to invest into FedNow. And so there's this huge push or trying to understand of what is this concept of FedNow, what is this tool or entity, and how do we get there, and does it help our members or our customers? And so I'll pause there. Do any of you guys want to jump in on that as far as the accounts or payments?
Caleb, one comment I'll make is I was on a call with a bunch of merchants yesterday, and almost all of them were interested in FedNow, real-time payments, pay by bank as a way to speed up payments and potentially lower their cost. And again, just when you start to look at retailers looking at alternative payment options, I think that's an interesting signal.
Yeah, I think, that's exactly right, Larry. And I think another thing, we talk about RTP and kind of those quick payments. Digital wallet's huge, especially on the retail side. I mean, that's something that I use on a personal level every day. I mean, they've made it so easy you can use it with your watch. It's just absolutely incredible, right? I mean, I'll be in Walgreens and somebody will be paying for something with their watch. I mean, that's crazy. But digital wallet is something that's growing rapidly. It has grown a tremendous amount, and it's projected to grow at 15% year over year for the foreseeable future. And that's tremendous growth in that area. And a lot of people, I think there's a misconception of what digital wallet is and what it includes. Is it a payment method in and of itself? And the way that we look at it is it's no different than your physical wallet that you carry in your back pocket, right? It is a tool. It is a conduit to use your debit or credit card. And there was, I don't think it came directly out of this survey, but it was in, one of these articles that we read and kind of went through. And 33% of the backing for digital wallet, meaning what you're using to pay, 33% of that is your debit card. And 31% is your credit card, right? And so that's a huge chunk of that right there. That's just your traditional FI issued debit or credit card. And so people are taking these traditional plastic cards, they're loading them on their phone and they're using them that way. And so we'll continue to see a lot of growth in that area. Dillon, I know you looked at a lot of that digital wallet piece globally. I think you were seeing the same thing, right? The same type of growth globally with digital wallet.
Yeah, even faster, really. And it's interesting, though, how other countries have started adopting more of an all-in-one tool. Like, so UPI is the main one that comes to mind from India, and then Pix in Brazil. And so these are government-backed rails that they're not quite pushing on the instant payments as much as FedNow is. But yeah, it's a digital wallet that you load up, and it has the backing of the federal government for all intents and purposes. So it's fueling adoption on a large scale there. And then also because of the resources behind it, you're seeing merchant adoption. And then the merchants get excited because it's so cheap for them. They start offering incentives to the consumers. You can see how it can cascade pretty quickly once powers that be start pushing.
Right, and we've
Dillon,
talked
you
about.
mentioned.
Go ahead,
I'm
Larry.
just gonna say you mentioned Pix. That's that one in Brazil. That has been so popular, it's actually been impacting Visa and MasterCard volume pretty significantly as a lower cost option for people. And Caleb, you'd said something about RTP and further adoption on that. I think I saw some news this morning with Navy Federal coming out and announcing that they have gone with RTP implementation. So that brings a number to, I think, 111 out of 5,000 credit unions that now have RTP. So we're probably just going to see continuation of that digitization and speeding up of payment systems, whether it's FedNow, RTP, alternative payment solutions like digital assets, and certainly mobile and contactless are, if they weren't big last year, they're even going to be bigger this year. I mean, I don't even use my phone, and I use my phone literally for everything. If I've got to pull a credit card out for something, it annoys me.
Yeah, and that's an interesting point you bring up. I think one last point I'll make on digital wallet, since you mentioned pulling your wallet out. When we talk about digital wallet, we talk about it in the sense of traditional point of sale. I think that's what a lot of people think of. When you're in Walgreens or Target and you pull out your phone and you double click and you use your phone to pay, and that's what we think of. There's a huge surge into digital wallet with e-commerce. I mean, it is just blown up. And I think the statistic I saw was as of 2023, I believe it was 30% of e-commerce transactions were made up from digital wallet. And that's been from a convenience perspective. And the main theme here, I think, that we see is convenience. From a consumer, what's convenient for me? For a bank or credit union, what do I give my customer, my member that's convenient? That is a huge convenient option. I mean, in our house, it's probably been good as much as it's been bad, because now we can go online to order something and I'm not having to go to the next room to pull out my card or my wallet. It's right there. It's super easy to use. And it's very beneficial for credit unions and banks, because that just increases your customers or your members using that card, making sure that interchange is flowing through the system. And so there's a ton of momentum there with digital wallet, and that's going to continue well into the future. And Paul, I think one other theme that we're seeing, and I'm glad Connor's on with us too, is AI. And this is a huge theme that we're seeing, and it's one that we're really seeing pop out Maybe one that wasn't as much talked about in 2023, but it's one that banks and credit unions are really saying, hey, we're interested in this going forward. And a big piece of that from what we saw, and Connor's the expert, I want to hear from him, but one of the big pieces we saw is customer service. And I think, these FIs incur lots of costs with customer service, with outsourcing to call center, whether they use their card processor or whoever it may be. And these chat bots or injecting artificial intelligence in some way has definitely helped with that. And that's something that FIs are very interested in. Connor, I'd love to hear your take on that.
Yeah, absolutely. And I'll talk a little bit generally about AI and then a little more on the customer service use case, but I'll try to keep it relatively brief. But I mean, 2023, we saw some of the most advanced AI capabilities in the world made accessible to everyone in the market cheaply all at once, right? Things like sentiment analysis of contact center transcripts and personalized marketing are rapidly becoming table stakes because anyone can just pull up ChatGPT and dump them in. Right. A custom in-house development is cheaper than it ever was before. That was what drove the mass layoffs in Silicon Valley and also the availability of really high quality developer talent in the marketplace. And then what we were seeing in 2023 was a lot of experimentation and piloting with new generative AI capabilities. And in 2024, we're expecting it to be much bigger and more implementation focused efforts, particularly by larger FIs really going full steam ahead. As with most new technology, smaller FIs are largely taking a wait and see approach, but that's a risk because the fintechs and the neobanks aren't. And they're the big competitor for Gen Z deposit dollars, much more so than like Chase or PNC. So falling too far behind on these capabilities, losing on these efficiencies is much more of a danger than it may have been in the past. Circling around to sort of the customer service question. So conversational AI and chatbots have been gaining sort of share in the FI space for the last 5 years. It's sort of like well predating the newest generation of AI technology. Now, that said, the new generation is impacting that sort of traditional, quote unquote, conversational AI. I think just this week, Apple made an announcement about their internal large language model and AI efforts, saying that one day a large language model based chatbot would be fielding inquiries to Apple support. So that's a pretty strong endorsement of the future of the technology because there's a question in the industry of whether large language models would be able to provide enough consistency and brand awareness to be able to be used in a customer-facing role. So most of the big providers have been very cagey about actually integrating the newest technology directly into anything customer-facing because of the risk of potentially providing false information or referring to a different institution. That's just inherent to the technology here. However, that's shifting, and there's a lot of different groups that are working on integrating the newest capabilities. Already there's usage of large language models in supportive capacities for chatbots, such as generating the training data or translating responses to a more natural conversational format. But none of the big players have really risked using a wholly large language model driven solution yet. But at least two of the big chatbot vendors I know are working on pilots to do that with kind of an orchestration layer, joining up the traditional intent-based model and the new large language-based model. And so, more and more the tech companies are shifting that way. So it's kind of a tricky time to decide, should we implement a conversational AI chatbot right now? I would say half probably of the institutions I talk to already have one in place in some form or fashion. And the other half have at least thought about it. So there's a question of timing of, do you want to launch something now so that you can deflect the massive volume of people trying to check their balance, depending on your member base, that could be more or less of an issue, as well as the state of your digital offerings. Or do you want to wait a little bit longer until the large language model based technologies are more mature and you can get a more naturalistic interaction. Because it does seem increasingly likely that's really where the market is going, even in the relatively conservative financial space.
You know, it is.
Go
Oh,
ahead,
sorry, I
Paul.
didn't. No, no, I was just gonna say it is an interesting thing. I was talking with somebody a couple of weeks ago about if you look at the gap, I mean the time lapse from the introduction of ChatGPT and it going from being a shiny new object to actual applicability, pretty short in the whole scheme of things, you know, relative to other technological innovations that we've seen in the industry over the last, 50 years.
Yeah, the pace of innovation has been absolutely insane. You know, it's exploded with more investment in AI than really any prior point in history. You know, all of the tech giants are jumping on it. Most of the large companies have partnered with the tech giants or partnered with startups or made acquisitions in order to bring some of those capabilities in-house, because there really is just so much potential for knowledge workers in really every sector. And it's sort of like some of the big companies, OpenAI notably, are sort of trying to speed run the innovation cycle, because typically what you see is you have a step change and then it takes industry, 5 to 20 years to sort of build solutions on top of whatever the new base capability is. But in this case, OpenAI made a bid to sort of own the marketplace of customized, fine-tuned models with their GPTs and their kind of crowdsourced marketplace. And that really undercut a lot of the hundreds of startups that had popped up. You know, the biggest example is like startups that were using AI to read PDFs and to summarize the information so you can interrogate data out of PDFs, because that was an obvious and easy use case that was, basically anyone could build. And so, dozens of companies did. And then OpenAI just built that into their own offering in just as part of a regular release. And so there's a lot of that kind of thing happening where there are these new capabilities coming out every month kind of thing. And it's causing a lot of disruption to the marketplace and introducing a lot of new capability, all under sort of the same umbrella. So it's this really exciting arms race where consumers really have and businesses really have a great deal, because there is so much that's new coming out very inexpensively. And these capabilities used to be the province of, massive multi-million-dollar projects at the likes of JP Morgan, right? And now almost everyone can access them for a fraction of that.
Well, great. Well, I want to shift gears too, because I mean, obviously, we talk a lot about technology, and how it seems to be, the panacea for so many things in the industry. But at the same time, there are going to be challenges and impediments to really being a more innovative financial institution. I'm curious if one of you guys wants to talk a little bit about some of your findings there. I mean, what are some of the things that kind of give pause to just jumping full force into, say, AI or into anything in the payment space?
Yeah, I mean, I think there are definitely challenges there, and I think the silver lining to those challenges, before we get into some of those, is that these financial institutions are recognizing the need to embrace technology. A very interesting part of the survey, and I think we all kind of had a light bulb moment when we read this specific piece of it, was when I believe it was credit unions and this specific, no, it was banks. For this specific survey, these banks were surveyed and asked, do you have the right tools to serve your various generation of customers? And they listed Gen Z, Millennials, Gen X, and finally Boomers. And Boomers and Gen X, banks really felt like they're taken care of. We've given them the tools that they need to succeed. There are no issues there. When you get to Millennials and Gen Z, it drops off a cliff. Banks start to get very, very nervous about that. Do we have the right tools in place to serve that generation, that demographic of our customer? And a lot of them feel like they do not. And so some of the challenges associated with that, knowing you need to change and kind of wrapping your arms around technology, a big barrier to this through the eyes of the banks surveyed is the integration with their core. Historically, the core has been the nucleus of the bank or the credit union. Everything kind of evolves around the core, if you will. And that is a huge barrier. A lot of the banks and credit unions that we've seen through these surveys think, okay, there's not a really good plug-and-play system. There was a question asked about, do you have a relationship with a fintech, meaning an entity that has created a product that you can use outside of your core? And 59%, almost 60% of the respondents said, no, we don't have any relationship with the fintech. We don't talk to fintech. We don't have any dealings with any fintech providers. And 65% of the same banks that were surveyed said they use their core for everything. And so what that's telling us is there's a fundamental misunderstanding about the current products on the marketplace today. And one of the things that we do when we have a core engagement is we look and see what are the different options, what are the compatibilities, what are the things that play nicely together? Are there things that we can introduce into this ecosystem that can help give you the tools that you're looking for without major disruption? And there are options out there, but I think it's cutting edge technology, right? So that's one barrier with your core, integration with your core. Another piece of it is the human side of it. So 53% said the adoption with their staff. So, having staff on board that want to embrace this new technology or lack thereof. And then finally, the customer. Will the customer embrace this new technology? So that's also a concern. And then last but not least is just the general concern of, do we have the right solution? Again, a lot of this centers around the core. And when you go through a conversion to maybe get to a better product that offers more cutting edge technology, that's a huge step. Is it the right solution? And so that's a piece that plays into it too. But among those challenges, I think where we really are seeing banks tell us that this is something that they're very interested in and they're making steps in the right direction. From those same surveys, we saw that 83% of the banks surveyed, and I think this was the highest statistic in the entire survey, 83% said that they've increased their budget for technology. And so they see this as something that they want to invest in. They see it as the future. They see those themes that we discussed and something they want to invest in, and they're putting their money where their mouth is, right? And so they're investing into that directly, and they're saying that. And then, a big piece of it too is, where do you get the understanding, or where do you get the thought leadership from to make those investments, to take those dollars you've set aside and make them work for you? 68% of the banks said that they use consultants. There were other options as well, articles and general things on the internet, but consultants far and above led the pack there as far as providing thought leadership. And Paul, the last thing that we saw there that kind of gave us pause, we all kind of had conversations about it, is 49% of those banks that were surveyed did not have a tech expert, did not have technical thought leadership on their board of directors. And I think that's a huge statistic, because we're saying everybody's moving to technology. The future is technology. We want to embrace it. We want to serve the Gen Z, the millennials. We want to put the tools in place necessary to do that. But we currently don't have thought leadership in a strategic place to make those decisions. And so that was just from the bank surveyed. I'm sure that's not the same for everyone in the country, but that's certainly something that they're looking into maybe changing in the future.
Yeah.
To dovetail off that, I was at a conference at the University of Mississippi, and one expert, or one CEO of a bank in Illinois, was there. And one initiative that he tried that I thought was a really great idea was, he said, all right, how can I invest in my young people? And so he got together Gen Z and millennials together and picked out some of his brightest and best and said, hey, I want you guys to pick an area where we can improve with our technology capabilities, and y'all source it, y'all do the work. And that's a way to invest in your young people, for one. But two, that's the generation that you're worried that you can't serve. I mean, That's what the surveys told us. And so when you're getting the input from young people, one, but also two, you're allowing the people that have grown up and used technology all this time to be a part of the decision making. I think it's a great way for one to get your staff on board, but two to improve your staff retention, which is also a big concern for banks and credit unions.
Yeah, I mean, and it's interesting too. I know we've looked at this before as well at at SRM that because of a lot of the things that you mentioned, Caleb, people are more open-minded with their core provider and potentially open to making a switch where maybe they had not previously. At the same time, I mean, with the advent of middleware options, the cloud, I mean, there are ways to still implement a strategy without being as core dependent as maybe banks and credit unions have been in the past.
Well, you mentioned the cloud. One of the other things, and you guys know I'm big on blockchain technology, but something that all financial institutions kind of need to keep an eye on is something called the regulated liability network. And so basically you think of the core as a general ledger, and every bank has their own general ledger. And part of the drawback of that is the speed of transfer and reconciliation process goes through as we move funds from one institution to another. And it's really moving debits and credits. We're not really moving money anymore. Well, this concept of a regulated liability network is being led by the largest banks in the country, the same groups that came up with RTP, the same group that came up with Zelle. And my concern is that smaller institutions might not get an opportunity to participate in the development of that, and will end up being sold that or being at a disadvantage because their ability to transfer money or to transact is going to be significantly higher than those on a unified ledger. And or what also might end up happening is smaller institutions will develop their own kind of network of networks. And Bruce, who's on the call, I know he can I'm sure he could talk about that all day, but that's one thing to kind of consider from a technology standpoint is, do these cores really turn into something else or leverage some other technology that allows financial institutions to lower their costs? And hopefully the smaller institutions can take advantage of that, and it's not just a purview of the big banks.
Something that I would add around barriers to change is just that a lot of FIs are not well structured for change agility. I can't tell you how many institutions I work with that don't have formalized enterprise project management capabilities. They don't have change management to foster adoption. They don't set KPIs and follow up on the outcomes 3, 6, 9 months down the line. They don't have strong corporate strategies, or they aren't using them to prioritize their projects. And that discipline is really critical to be able to plan and execute change in this environment where change is faster than ever, especially in technology. A lot of smaller FIs also outsource almost all their IT. They'll have one developer on staff who knows how to do some configuration, maybe integration work with the core, but be beholden to vendors for almost everything else. No in-house programmers or testers. And that saves on costs, but it's limiting ultimately. I hear from clients that they can't get a new feature in their digital banking for 6 months or more because the vendor's backlog, right? Like that's an extremely common thing that I hear. I see some heads nodding. So it's important to have a strategy, to be structured for change, to have the organizational areas, the policies, the procedures to actually implement and adapt in our world of increasingly fast change. So it's important to not just assume that there will be some vendor to swoop in and that you can have as a turnkey solution to do this, because you have to have these organizational capabilities embedded into your culture to be able to keep up.
All terrific observations. I would love to keep the conversation going. I do want to just be mindful of the time with about 15 minutes left. Let's open the floor up to some questions. See if anybody feel free if you want to weigh in, or if you want to just post in the chat. I'm happy to throw it out there. Anybody?
Yeah, this is Jeff here. I've got something.
Hey, Jeff.
Specifically in the payment space, I feel like from my perspective, the payment space is really messy at the moment. I think there's a lot of new innovation coming out. Some innovation is being built on legacy rails, other innovations being built on new rails. And I think of things like, think of like FedNow as an example. And I wonder, is that model, or are we at a point where, I don't know, some of you that might have been around in the BlackBerry days, if you think about before mobile devices really became, a big thing, BlackBerry really lost out because they didn't innovate and they were focused on, the keyboard and all of those types of things, when, Apple and Android were building ecosystems of developers and building apps around all of this. And that's what we're seeing right now in more the emerging technology space. And so when I think of things like FedNow, is that, is a credit union or a bank trying to invest in their payment strategy, do they go that route? I kind of align that to investing in those BlackBerry servers that we used to have to purchase, right? Maybe it's the right way to go. I mean, but maybe we're at a point where we're talking about BlackBerry or the new next thing, right? So I'm curious to see if anybody else has a similar read, if we're, faced with that scenario essentially right now.
And Jeff, it's a little of like the leapfrog scenario where you think about like telecoms in some emerging countries, rather than stringing copper lines up, they ended up just jumping right over that and going to mobile, right? Or what we're seeing in some developing countries where they don't have strong banking networks, they're going right to digital assets. And so there is that opportunity, I think, even for the US to go think innovatively. And is there something that can allow us as banks and credit unions and in the fintech space to do that same sort of leapfrog without continuing to just layer on Band-Aid upon Band-Aid on these existing old legacy systems that, served us well in the past, but are getting slow, expensive, and cumbersome?
Yeah, I think that for me, it's really understanding how does like tokenized deposits weave into something like FedNow, and how does FedNow weave into something like what PayPal's doing with their stable coins. And, it's just all of these, different approaches to solving common problems or similar like problems, is what gets me, I guess.
Yeah, one fun example of what Larry mentioned about leapfrogging technologies and sometimes having younger, more newly developed countries leapfrogging more developed ones because they don't have the same legacy. My favorite example of that is probably Estonia, which is the sort of most digital country in the world from a government services perspective. I think just quickly checking the stats, like 99% of their public services are available as e-services. Filing a tax return is extremely quick, a matter of minutes. Voting occurs online. All patients have centralized electronic medical records, and a lot of that is administrated via blockchain. So it's one of those cool examples where not having, as you put it, those like layers of Band-Aids on top of old systems has let them be a lot more advanced and to save, at least according to this PwC report I'm looking at, 1,400 years of working time and 2% of GDP annually. So the potential here is potentially very, very high, right?
Yeah, in a similar sort of, I guess, topic, with cores, I've been a technologist my whole life, and I've worked at many companies that are looking to replace their mainframes and have successfully. I feel like, in the financial space, the FI space, they're usually coming, to the table a little bit later than a lot of other organizations. This is kind of the nature of the beast. But I fully personally see a world where you really sort of decompose those core systems and you start building out microservices or other types of architectural strategies that give you that flexibility to be reactive in a market that's really changing. Because I do feel like this whole financial space is now being disrupted. It's the financial space's turn to be disrupted, right? And so in order to be really nimble, you need to be thinking that way as an institution.
Jeff, I know Bruce wanted to jump in there with a comment. Before that, you talk about being disruptive. One of those other things, you think about traditional finance, one of the biggest strengths was the data, right? The data of their customers, the data of their members. Well, as a lot of you probably know, the CFTC is going to be rolling out open banking in the U.S. It's going to start to come to fruition end of 2024, beginning of 2025. And there'll be some rollout time, but that secret data that we've all been so fond of is suddenly going to be able to be moved at the customer's request or the member's request to fintech partners or other competitors. Or now there may be an opportunity for community banks and credit unions to take business from the big banks. That data can go both ways, but that's something to think about as people think about strategically planning for the next year or two. That's going to be either another opportunity or another risk, depending on how you look at it. Bruce, you had raised your hand. I think you were going to jump in on an earlier comment. So you're on mute. Button. I might be able to unmute you here. Hold on.
Can you hear me now?
Yeah,
we
you
can hear
got
you
it.
now, Bruce.
Yep. So Larry and I have known each other for a little over 2 years and change, and the rest of you guys, thank you for presenting and introducing yourselves to us. Connor, I echo your comments 100%. We're a blockchain infrastructure firm that enables financial institutions to get more involved with the blockchain. We provide the middle and back office software, but the KPIs, the enterprise forward thinking, and the cores, today, like what you said, when you want a project done, it's like get in line and give me a couple $100,000 to do a small change, and it's just and this technology will leapfrog, the blockchain technology will leapfrog existing cores. And we have inside our platform, we have what's called user link, and we don't need to really interact a whole lot with the core other than give them a ID number and port them over to the blockchain, because they've already done the KYC AML, and that then those clients can get on the blockchain if they so deem worthy for that institution. So it's just one of the small features in our platform. Happy to chat with anybody offline, that wants to get into a greater detail.
Sounds good. Hey, Lou, you raised your hand. You have a question for the group?
Yeah, so funny, I raised my hand because I was going to ask about CFPB's proposed rulemaking for open banking. And just as I raised my hand, Larry started talking about it. So I'll move on to my next question. Adoption of instant payments. I think it was Caleb who mentioned a stat like by this time next year, 67% financial institutions plan on participating in FedNow. Most likely it'll be receive only. The credit unions that I got a chance to speak to PSU owners who were early adopters of the clearinghouse's RTP, and almost all of, in fact, all but one that I spoke to said within hours of going live with the clearinghouse's RTP, like that morning, they were already seeing transactions posting to their core, and that was all like DoorDash, Uber Eats, Instacart, so the gig economy payroll. There was a bunch of account to account and then wallet emptying transactions is what they were seeing. FedNow rolls out, and one of our owner credit unions was in the first wave of FedNow rollout, receive only, and a month later, I have to trust that they know what they're looking at, what reports they're looking at. Said, yeah, we've seen 0 transactions. And it's like that seems a little odd, but the way that credit union explained it is, no, there's just no senders on FedNow, whereas the early adopters of the clearinghouse's RTP, because they're the owners of the clearinghouse, were the biggest banks who also have large merchant accounts, which were the early senders. So, and then when you hear about like ADP, Certegy, and the large payroll providers, well, they work with those large banks that, 2, 3, 4 years ago, they rolled out with the clearinghouse's RTP. So that was my whole lead up to, yes, a lot of credit unions now are claiming that they're going to participate in FedNow. Lots of at Money 2020, there was just lots of discussion about FedNow, almost like RTP didn't exist. It's all about FedNow, and this is going to really drive them. We're finally going to catch up to UPI and PIX and other countries, but there doesn't seem to be senders. What's there? That's my whole setup. What's your take?
I'll jump in there if you don't have an automatic an answer. I think we will see them ultimately get pushed. Like credit unions also have merchant relationships as well, right? And their merchants are going to push them to have the send as well as receive capability. So I think ultimately you'll see them do that. You know, the slow adoption is that no one wants to lose deposits, right? They don't want to see those outgoing, but they're happy to take money in. Well, that's all well and good until your corporate customers or your merchant relationships start saying, hey, I need to be able to send and receive. And so I think it's just a matter of time from an adoption standpoint. And in the meantime, you know, we're seeing pay by bank and heavier usage of ACH. I think it's just a continuation of people expect faster settlement, more flexible settlement, and I think that's just the direction the world's going. But happy to hear others' opinions on it.
I think it plays directly. And so we talk about the next 18 months. We talk about the previous 18 months and where investment was, and then we talk about the next 18 months. And FedNow is certainly something that we saw on everyone's radar. And so 67% we're looking at either implementing or beginning the journey of trying to understand what does that look like for their members. 53%, so the second option under FedNow, wants to implement contactless cards. And what that tells me, because that's something that's been around, that's being adopted as we speak, what that tells me is it continues the theme of convenience, getting the tools into their members or their customers' hands where they can pay freely, where they can exchange funds freely, and thus obviously increasing interchange within that bank or that credit union, and most importantly, just providing convenience, making sure that the tools are there for their members or customers to be able to use. And so, you know, we've put a lot of emphasis on FedNow. That's the you know, the new kid on the block, so to speak, and everybody's kind of wondering what that will be. The traditional payment methods and payment rails are being invested in just as much, and that was apparent in our research as well, with contactless, with digital wallet. I think it all comes down to less mode and more convenience, more conduit. How do I get those tools, regardless of what they are, for the consumer to make their choice?
Caleb, you talk about convenience. A conversation I had recently was again with some merchants, and they've started to see decreases in PayPal volume, right? PayPal was the most convenient thing you could use for the longest time because you didn't have to enter all that merchant information, your credit card information. Well, now we've got all the pays, right? Apple Pay and Samsung Pay. And not only do you don't have to do that, all you have to double click is on the side of your device, and suddenly that transaction occurs. Or for those that you have an operating system on their computer that's integrated, you can be shopping online on your Mac, and you go to purchase with your Apple Pay, and you just verify the transaction by staring into your phone and clicking twice on, like that level of convenience is what wins. And so as banks and credit unions, we need to think about our technology, and are we making it convenient for our members and our customers? Because if we're not, we're going to lose out to those institutions, whether they be fintech or other, that are making those transactions easy.
And Larry, just one real quick question. I know we're going to wrap up here, but somebody did ask about the governance entity that you mentioned earlier. Were you talking about the CFTC? I'm trying to remember.
CFTC, yep. Yeah,
Okay,
that was
great.
the CFTC.
Well, great.
Real quick, I know we're wrapping up. I want to most of you have participated in this before, but for people who don't know us, you know, strategic resource management is a lot of our business is negotiating third-party vendor contracts, and we're very happy to do that with anybody. But we also have a thriving advisory business that focuses on payments, core operations, technology, digital assets, artificial intelligence. So, you know, we love everybody's participation. We learn as much from these as probably you guys learn from us. We are always encouraged to have this level of participation, but if anyone wants to take that relationship a little bit farther, we would be more than happy to engage with you on any sort of projects. And with that, I do want to thank our guests, Dillon, Caleb, William. You guys did a great job today. It's always nice to have some other voices. And Paul, as always, you're great at moderating a conversation. So I just wanted to say thank you, Paul. I'll let you wrap it up, but I do appreciate everyone's joining us for these.
Yeah, no, I appreciate it. Again, thanks to everyone for attending. A huge thanks to our panelists today. And Larry, as always, just a reminder that if you guys do have continuous questions, I mean, this is obviously an ongoing conversation. Never hesitate to reach out to us and continue to have that dialogue, because obviously this is something that's going to be always front of mind for us, I'm sure for you guys as well. So with that, thanks again for attending our most recent Tech Talk session.
Thank you all.
Take care. Thank you.
Thanks.
Thanks, guys.